If you don't know me, I am the guy who tests and validates day trading strategy. And I show you in practice with live and real trades whether the strategy worth it or not. And today we'll be testing the Wyckoff model, which is basically the most faithful model that exists in the smart money concept. Wyckoff just founded a market methodology as an institutional one. If you don't know what is Wyckoff model or smart money concept, I will explain to you. So this is the accumulation model of markets. In the accumulation, the markets tends to capture liquid zones. If you don't know what is liquid zones, these are areas where big players and small players put money, that is support and resistance. And how is this capture done? In this image here we can see the price falling, forming patterns and being captured by the spring. So look, this is spring here. This spring is when the big players capture the liquid zones. This support here is being captured by these big players. So remembering that some went wrong and others went right. So let's go to the chart and look for some zones that look like with this Wyckoff model of accumulation. So here am I on the chart, and let's look for the accumulation pattern. And the step one is looking for the liquid zone, that a high liquidity. All right, high liquidity, what you call support and resistance. The big players call them liquidity zones, which are captured by large institutions that rule the market. For the simple reason, let's assume that you want to buy $1 million of this commodity here. No one is willing to sell. What do they to them? They let investors speculate until they form this whole liquidity zone here, and then they capture the zone, doing so the famous spring, and then they look for heat test, and here it will be the perfect place for buy or sell. And then that is exactly what the price does. Here are some analysis that I did myself. They are appearing on the screen. Well, I've already tested this operation myself, and I can tell you that they are little fluid. One thing that really help us to maintain consistent and profitable on the market is your risk return. It should always be at least 3-1 or 2-1, so that at the end of the month you can stay positive. So the first episode of our series ends here. If you support content like this on YouTube, leave your thumbs up and your comments below. Don't forget to subscribe to the channel. See you in the next video. Goodbye.